Hey everyone, time for the market review. And this week didn't really go as expected. My last video was on Monday. We were around here, and I thought we had the potential to go a bit higher to tag this AVWAP to standard deviation line, but instead we got a correction and bounced off the same AVWAP, went a bit higher and kind of choppy. I still think there is potential to go here, although the possibility is smaller now than before, and do like a fake out to this level. But overall, we might get a bit of rotation due to quarterly OPEX. We might get software going up a bit again for next week. Indexes shouldn't really go higher. Again, maybe marginally so to this extreme to standard deviation from this AVWAP, but we're still oversold. My thesis remains the same that we are in a chop scenario, and being in a chop scenario at the top of the range, this means short-term bearish or mid-term. It's short-term, mid-term. I'll explain in detail. Now, this was Qs. It's the main thing we watch because everything goes based on it. This week, in spite of going higher or going lower, breadth has been basically non-existent. We take US 100, okay. And on this day where we went up on Monday, we were at 7 something, no, 67 new vol. Then when we went down, we were at 51 devol. No, this one. Oh, we were higher, like 60, 70, something like that. I was right flat. Then again, so what point is I'm trying to make is that whenever we go down, whenever we go up, breadth is still generally pretty shit. Like on Friday when we went up on Qs almost 2%, we were at 54 UVO. And breadth is not responding to what's happening with tech. Most likely because many of the tech names are not listed on Nasdaq, and this breadth UVOL DVOL McLaren oscillator tracks the New York Stock Exchange, and it's visible here as well. Like we haven't really gone up in breadth, and I don't really expect this to change anytime soon before we correct. And I'm going to show you a couple of things as well today that reinforce the thesis that we are going into chop and we will be, this means down in the next 2 weeks to a month. But I would expect us to, wherever we find a bottom, which could be very relatively close to where we are now, like for example, could go slightly lower than this, we will go back to the highs very, very shortly. Now, I've been showing you guys the liquidity uh, analog, which Amazon seems to be following it the best. I posted the week before that I went long Max 7, which initially worked out, but with this big reg day we had here, didn't really work out that well. Now it's back to slightly down. My position across the multiple names is slightly down, but I still think we continue going a bit higher, potentially the entire of next week. Initially, I thought we would go like until Tuesday, Wednesday. We could go on for the entire week, and then a leg down begins. So I'll update the comparison directly. I'll disable this for now, and we'll look at it. Come on, what am I hiding? This one is the one I'm trying to hide. So this is the Amazon analog. You see that it's following it very well. We are basically here, which gives us another at most 5 days of what we're here. And then we have 1, 2, 3, 4, 5 days. Another up to 5 days of sideways up chop before the another leg down, and then we get like 1, 2, 3, 4, 5, 6 days of downside, and then this is like 8 to 9 days of upside, and this will be more pronounced and a stronger move up. And then the downtrend begins. And like I said, all the Max 7 names have been following this quite well. This is Microsoft, although like I don't mean at magnitude, but I mean as direction. So we went down here, we went up in this part, now we're going down. And again, for Microsoft, we are here. We should be expecting to go a bit higher. IGV following it very well as well. Again, not in the path necessarily, but in magnitude, but in the direction. And we go up from here. We went down from here. We should be expecting a bit of up, then down again, then up more, and then down. Even names like MU, which they follow it with a lag, but it's been pretty well correlated, like upside, downside, upside, downside, upside, and then it went exponential. Even in this exponential phase, it respects it with a lag. Like for example, when we had this correction here, we did get it in MU eventually. This was like minus 30, 40%, even though it doesn't look like this, but the chart is distorted by the move up. So I would expect MU to react as well because of but with a lag. There's also the aspect of quarterly OPEX, which we just had, which doesn't really have that much of an impact on many names, but because the deltas are kind of neutral. For example, Microsoft, slightly negative delta that went. This is the delta, the premium that went away, not delta, the premium that went away. That isn't really impacted quite that much. Like Meta, again, not that impacted because of the expiration. But stuff like MU, where do I have? I don't have it. MU. We have 16 billion of delta expiring, and it's all in the money calls. So that's a lot of expiration to go away, and it should have an impact by stalling it and not allowing it to go higher from here, and basically doing a topping pattern. Now, another reason why I don't think we get an expiration, a move quite yet to the downside, and I think we still go up, is because the way SPXW works, it doesn't have the expiration on um, uh, on the third Friday, sorry. So it didn't really expire on the 18th, although it had the expiration as it does every week. But the SPX expiration is actually on at month end. So we still have 12 billion in uh, positioning that will expire at the end of the month. So I think it's plausible that we could go sideways up at the index level, have a rebound in stuff like software, while semi stall. So I don't think they fall quite yet, but they should be stalling, meaning they go down, they go up, they go down, they go up, kind of like they've been doing the entire week. And until we get to the month turn, I don't think that there's such a huge risk of everything turning back down. So I expect like at the minimum at least 3 to 5 days more, but more like 5 to 7 days of sideways up, a bit of rotation here, a bit of rotation there, that will keep the index pinned near the highs. Of course, I thought the same for this week, and it kind of happened. But we did have that big red day that kind of messed things up and turned the bullishness down. But liquidity model predicts that we have a bit of a period in which we can go up, but it also predicts that we're going down. Now, what I wanted to show as well was um, you remember that we have those analogs of the previous years that I've been tracking for SPX. Let's look at them right now. I'll close these things, we don't need them. And the previous ribbon, we don't need it. And first, we were in this period in which market had corrected, we were going up, and I thought this 9066 analog would be okay, but it broke down here. Instead of going down, it went up, and it's no longer relevant, so we don't care. Then we have 1999, which mm, it doesn't really fit. Like can't see any comparison. You cannot adjust it to make it look better. So I don't think this is valid as either. Then we have the 2000 one and we have the 2007 one, which both fit pretty well. It's not a perfect match, obviously, but both this one works better if we offset it to the right a bit. But what this one predicts is sideways chop as well. So this looks like a market top as well. and after this we go down, we create a range, probably not as low as its showcase here, and I'll show the 2007 one, which I like the most, and let's look at it right now. And this one works very well. And what I kind of expect will happen in the following period is we will define this range here. So we will go to the gap fill, we will not fill the gap, and we will build this range between 6755 and the top at 7500. So I would expect the market will go very similar to what it looks like here. Basically, another week or so until we top out and we go sideways in this smaller range between 70 to 62, 7 to 62, and 750, 760. And afterwards, we do a bigger correction. We go to this gap fill here. We don't fill the gap, and then we bounce and go back to the highs for the rest of the year, or not for the rest of the year, like going into fall, then another correction. But basically, both the 2000 analog and the 2007 analog suggest that we are in chop mode. Liquidity suggests we are in chop mode. And there's one last thing I want to show you guys. In that we have SPX, and then we have HIG, which is high yield bonds. Let me do a scale, regular. And what you will notice is that we have a very large bearish divergence building here on the comparison with high yield bonds. This is generally speaking very negative for stock, and often foreshadows major corrections, or at least corrections, if not major. And we can go back in time to quite a long way back and see that this has been a very good predictor of tops and incoming corrections, both small and large. For example, at the 2007 top, while SPY was still making highs, HIG was going down very quickly. And this is basically the corporate bond market ETF, because those are the high yield bonds, and we know what's going on with the new IPOs. We know what's going on with the debt raising by various companies, including the Mag 7, which have not been doing that for many years, and it's basically overloading the bond market on the corporate side. It's more difficult to raise money. Everyone is trying to to absorb liquidity, basically, including governments. So governments are also doing huge deficits, and they haven't reduced their debt issuance at all. The market is going to have trouble absorbing that debt, and we see yields going higher. We see corporate bonds going lower. Basically, this is what HIG shows us. And in this scenario, the stock market is not going to have a lot of fun very soon. So this is one example, like I said, in which SPY went higher, or SPX went higher, and corporate bonds were going lower, and it foreshadowed a correction here. Afterwards, it went in sync, but if we look at it, we'll see many examples of this type of behavior in high yield bonds. Like for example, where do we find one? This one here. Again, high yield bonds were going lower, or making lower highs like this, time in which SPY was making higher highs like this, and eventually SPY did a correction, and it had a very choppy period here while high yield bonds were going lower, in spite of the recovery, but it was still a choppy recovery as well. Let's find some other examples, like here as well. SPY was It's the same period as here, and we had a rounding top developing. High yield bonds were going lower. I think I am going to draw it like this because I have to keep clicking the other one. So yeah, SPY was going like this, and again foreshadowed this recovery. Uh, High yield bonds were going even lower, so this recovery did not stick, and it's a very common pattern that we see when before SPY corrects in a big way. Same here. SPY was going exponential and high yield bonds were going lower, foreshadowed like this is like a 20% correction. Here, not so much. This is February top. the the, the COVID correction. Same kind of here. It was smallish, the divergence, something like this, and this was like this. Same here. This was like this, and this was going exponential. 2021 top was the same. Like we have a clear downtrend in high yield bonds, and SPY was making new highs. This correction kind of foreshadows as well. This one here as well, meaning something like this, and SPY was going higher. This one as well, like higher bonds were going or had topped before and wasn't going higher, and so on. So now we are back to the present. We have a very clear continued divergence, even though especially this one here. So the other ones are less important, let's say, but this one in which uh, high yield bonds stopped here and the market kept going higher is a very concerning divergence. And it continued on the other tops as well. Like this could have been something like this, and then it went higher afterwards on the second top, and that wouldn't have been concerning. It would have been constructive. It means it could have went higher, but this is not what's happening. We still have a trend that's going down. They're failing to make new highs, and considering the context with liquidity and financing and the AI build out, I doubt this will get out of this downtrend very anytime soon. So all of these things, liquidity, the divergence with higher bonds, the OPEX coming that just passed, and everything is pointing to the market being on its last leg as it moves higher. And I would expect it that we go slightly higher, like I said, sideways up for the next 1 to maximum 2 weeks. But when we start going down, it should be felt by everyone. And I would expect that once we start going down, we will fill the gap. Where was it? I have to look on SPY here. Holy shit! I have so many things drawn on. Let me reset SPY like this, and I want to turn off this as well, make it a bit cleaner. So target would be this 775 level around this year for the bigger correction. But again, that's coming later in the summer, most likely, probably like in July or August. For now, we still continue grinding higher for another week or so, and then the correction begins. It will be choppy correction first before the eventual, very similar to this, before the eventual drop. We will have a period of like 2 to 3 months at most in which we do something like this. Eventually, we start making lower highs, and that's going to be when we get a flush level once we go below this level. For now, so the next, let's say, 1 to 3 months, because it's impossible to tell how quickly we will get a reaction. I would expect we will go sideways in this range with potentials for overshoots, but not significant ones to the upside or to the downside. We do something like this, we bounce again, we do something like this, we do it like this, then we start making lower highs, we eventually breaking down and we do a flush down, and then we go back to the highs to 760, something like this. So this is my expectation of how things will play out in the short and midterm. We'll see if this holds true, but that's it for this week. Have a good one. Bye bye.